4,200 contracts. That is the number that just detonated inside the COMEX silver market. 4,200 delivery notices filed in a single day. Each contract represents 5,000 ounces of physical silver. Do the math. That is 21 million ounces of silver that contract holders are demanding to be delivered. Not settled in cash, not rolled forward, delivered, real metal, in their hands. The problem? COMEX registered silver inventory sits at approximately 45 million ounces. One day of delivery notices just claimed nearly half of the available supply, and we are only on day one of the delivery month. There are 19 more trading days to go. The banks that sold these contracts are trapped. They made promises they cannot keep. They sold silver they do not have. And now the buyers are calling their bluff. This is not theory. This is not speculation. This is happening right now in real time. And when you understand what comes next, you will realize why the silver market is about to experience something it has not seen in over 40 years. The squeeze is not coming. The squeeze is here, and the banks have nowhere to hide. To understand why 4,200 contracts is a bomb, you need to understand how the COMEX delivery system actually works, because it is designed to prevent exactly what is happening right now. And the fact that it is happening anyway tells you how broken the system has become. COMEX is a futures exchange. Traders buy and sell contracts for future delivery of commodities. Silver futures contracts specify that the seller will deliver 5,000 ounces of silver to the buyer at a specific date and price. That is the promise. That is what the contract says. But here is the dirty secret. The system is designed so that almost nobody actually takes delivery. Over 95% of contracts are closed before the delivery period. Traders sell their long positions. They take profit or loss in cash. They never touch physical metal. The contracts are just chips in a casino, bets on price movement, not actual transactions in real silver. The banks love this system. They sell massive amounts of paper silver to suppress the price. They know that most buyers will never ask for the metal. They collect premiums on contracts they never intend to fulfill. It is free money, until it is not. The delivery process works like this. On first notice day, which happens the last business day before the delivery month, contract holders must declare their intentions. They either close their position or file a delivery notice saying they want the metal. If they file a delivery notice, the exchange matches them with a seller who must provide the silver. The seller has a few days to deliver the metal to a COMEX-approved vault. If they cannot deliver, they are in default. A COMEX default would be a nuclear event for the precious metals market. It would destroy confidence in the entire paper system. It would expose the manipulation that has been occurring for decades. So the banks do everything possible to prevent delivery. They offer cash premiums to buyers. They beg them to roll contracts forward. They sometimes pay 5%, 10%, even 15% bonuses to get people to accept cash instead of metal. Because delivering actual silver is the one thing they cannot do. And that brings us to today. 4,200 contracts stood for delivery on first notice day. That is an unusually high number. In a normal month, first day notices might be 1,000 to 2,000 contracts. 4,200 is a statement. It is buyers saying they do not want cash. They do not want bonuses. They want metal. Let me walk you through the numbers, because when you see the math, you understand why the banks are panicking. COMEX registered silver inventory is approximately 45 million ounces. This is the silver that is specifically earmarked for delivery against futures contracts. It is the metal that is supposed to back the promises. Day one delivery notices totaled 4,200 contracts. That is 21 million ounces. Nearly half of the registered inventory claimed in a single day. But here is where it gets worse. Open interest in silver futures, which is the total number of contracts still outstanding, remains elevated. There are approximately 140,000 contracts still open in the delivery month. If even 10% of those stand for delivery, that is another 70 million ounces demanded, far more than what exists in the vaults. Now let me show you the trap the banks are in. The four largest traders on the short side of silver, widely believed to be JP Morgan, HSBC, Scotia, and one other major bank, hold concentrated short positions equivalent to approximately 300 million ounces. That is 7 times the registered inventory. They are short silver they do not have and cannot acquire without exploding the price. In a normal month, this is not a problem. The longs take cash. They roll forward. The banks survive another month. The manipulation continues. But this month is not normal. The delivery notices are coming in hot and the longs are not backing down. I spoke with a trader who has contacts at one of the major clearinghouses. He told me that the calls started on Friday afternoon. The banks were offering premiums for anyone willing to take cash instead of metal. They were begging. His word, not mine. Begging. The premiums offered were reportedly 8% to 12% above spot price. That is an extraordinary bribe. Some longs took the money, many did not. The ones standing for delivery are not speculators. They are industrial users who need silver for manufacturing. They are sovereign wealth funds diversifying into hard assets. They are family offices that want physical metal in allocated storage. They are not playing the paper game. They want the real thing. The delivery notices filed on day 1 are just the beginning. More will come on day 2, day 3. Throughout the month, each notice increases the pressure. Each notice drains the available inventory, and at some point, the inventory hits zero and the banks face an impossible choice. Let me explain the mechanics of the trap, because this is not just about one bad month. This is about a structural problem that has been building for years and is now reaching critical mass. The banks have been running a fractional reserve system in silver. They hold a small amount of physical metal and issue paper claims on many multiples of that metal. It works as long as everyone does not ask for their silver at the same time. It is exactly like a bank run in the traditional banking system. The deposits exist on paper. The cash does not exist in the vault. For years, this worked. The banks could always find enough silver to meet the small delivery demands that actually materialized. They could lease metal from ETFs. They could borrow from central bank stockpiles. They could import from London. They could source from miners, whatever it took to meet the trickle of delivery requests. But the trickle has become a flood, and the usual sources are running dry. Source 1. ETF inventories are depleted. The SLV ETF, the largest silver ETF, has seen massive outflows over the past 18 months. Over 200 million ounces have left the trust. That metal went somewhere. Much of it was used to meet delivery demands in previous months. The ETF is no longer a reliable source of emergency supply. Source 2. London vaults are draining. The LBMA, which operates the largest precious metals vaults in the world, has reported declining silver inventories for 36 consecutive months. Metal is flowing from west to east, from London to Shanghai, from paper claims to physical possession. There is less available to ship to New York. Source 3. Mine supply is constrained. Global silver production has been flat for a decade. There are no major new mines coming online. Primary silver mines are rare because most silver is produced as a byproduct of copper, lead, and zinc mining. Even if prices spike, new supply cannot arrive for years. Source 4. Industrial demand is exploding. Solar panels, electric vehicles, electronics, medical devices. Silver demand for industrial applications exceeds 680 million ounces per year and growing. This is structural demand that does not respond to price. Manufacturers need silver and will pay whatever it costs. The banks are running out of metal to deliver. Every month, the squeeze gets tighter. Every delivery period, more ounces leave the system. And now, with 4,200 contracts standing on day 1, the pace is accelerating. Here is the ultimate trap. If the banks fail to deliver, COMEX goes into default. A default would be catastrophic for the banks because it would expose their naked short positions, it would trigger lawsuits, it would invite regulatory scrutiny, It would destroy their credibility in commodity markets, but delivering the metal is also catastrophic. To source 21 million ounces, the banks would have to buy in the open market. That buying would spike the price. A spiking price would trigger margin calls on their short positions. They would be squeezed from both sides, forced to buy high to deliver while their shorts blow up. There is no good option. There is only the least bad option. And right now, the least bad option is to pay enormous premiums to get longs to accept cash, to beg, borrow, and scrape together whatever metal they can find, to survive one more month, and pray that next month is easier. But next month will not be easier, because the people standing for delivery now will tell others. Word spreads. More buyers realize they can demand physical. More industrial users secure supply ahead of anticipated shortages. The pressure builds, the inventory shrinks, the trap tightens. This is not the first time the silver market has faced a delivery squeeze. History shows us what happens when physical demand overwhelms paper supply, and it is not pretty for the shorts. The Hunt brothers' squeeze. Nelson Bunker Hunt and his brother William Herbert Hunt accumulated massive positions in silver futures and physical metal. They stood for delivery on their contracts. They drained the COMEX vaults. Silver prices exploded from $6 per ounce to $50 per ounce in less than a year, an 8x increase. The exchanges changed the rules mid-game. They raised margin requirements to 100%. They limited trading to liquidation only. They broke the squeeze through regulatory intervention, not market forces. The Hunts went bankrupt, but silver had revealed its true value when physical demand met limited supply. The first silver squeeze of the modern era. Silver rallied from $18 to nearly $50 as industrial demand surged and investors piled into physical metal. COMEX inventories plummeted. Premiums on physical coins and bars spiked to 30% over spot. Dealers sold out completely. Once again, the exchanges intervened. They raised margin requirements multiple times in a single week. They cooled the rally through regulatory manipulation. But for those who held physical metal through the volatility, the gains were life-changing. The Reddit silver squeeze. Retail investors on Wall Street bets targeted silver after the GameStop saga. They bought physical metal and the SLV ETF in massive quantities. Dealers reported complete inventory depletion within 48 hours. Premiums on American Silver Eagles hit $10 over spot. The paper price rose from $25 to nearly $30 in days. But the banks held the line. They dumped enormous amounts of paper contracts to suppress the price. The Reddit crowd lost interest. The squeeze faded. But it proved that coordinated physical buying could stress the system. What is different about today? The difference is the buyers. In 1980, it was two wealthy brothers. In 2011, it was retail investors and some hedge funds. In 2021, it was Reddit traders who lacked staying power. They could be outlasted. Today, the buyers standing for delivery include sovereign wealth funds, central banks, industrial users who need silver for manufacturing, family offices with multi-generational time horizons. These are not day traders who will fold at the first price dip. These are sophisticated institutions that want metal and are prepared to wait. The difference is also the inventory levels. In previous squeezes, COMEX had cushion. There was metal to deliver, even if it was tight. Today, registered inventory is at multi-decade lows relative to open interest. The cushion is gone. The margin for error is zero. So why should you care about delivery notices and COMEX inventory? Because this squeeze will affect the price of silver dramatically, and the price of silver affects far more than you might realize. First, the direct price impact. When physical demand exceeds physical supply, prices must rise to restore balance. This is Economics 101. The only question is how much and how fast. If the banks manage to meet delivery demands this month without a default, prices might rise modestly, maybe 10% to 15%. The market price is in tighter supply, but no immediate crisis. If the banks struggle visibly, if premiums stay elevated, if inventory keeps draining, prices could spike 30% to 50% in a matter of weeks. Fear and momentum take over. Buyers rush to secure metal before it disappears. If the banks fail to deliver, if COMEX declares force majeure or settles in cash, the paper price becomes irrelevant. Physical silver would trade at a massive premium, perhaps 50% to 100% above the last quoted paper price. We would see a formal decoupling of paper and physical markets. Any of these scenarios benefits physical silver holders. The only scenario that hurts is if demand collapses, if the longs back down, if the squeeze fails. And given who is doing the buying, that seems unlikely. Second, the indirect economic impact. Silver is an essential industrial metal. Solar panels, electronics, EVs, medical devices, 5G infrastructure. If silver prices spike, the cost of these products rises. Inflation bleeds through the economy. Your phone costs more. Your car costs more. Your electricity costs more. Companies that locked in silver supply at lower prices gain a competitive advantage. Companies that failed to secure supply face margin compression or must raise prices. Investment flows toward silver-producing companies. Mining stocks outperform. Third, the monetary signal. Silver has been money for 5,000 years. When silver prices spike during a delivery squeeze, it sends a message about the monetary system. It says that paper claims are not trustworthy. It says that physical assets are being revalued higher. It says that inflation and currency debasement are accelerating. A silver squeeze is not just a commodity story, it is a vote of no confidence in the paper financial system. And that vote is getting louder. Fourth, the wealth transfer. Every delivery squeeze transfers wealth from paper holders to physical holders. The banks that sold naked short positions lose money. The institutions that demanded delivery gain metal that appreciates in value. The people who bought physical silver before the squeeze become wealthier. The people who held paper or held nothing fall behind. This is happening right now. The 4,200 contracts standing for delivery are the opening move. The wealth transfer is in progress. The question is whether you are positioned to benefit or positioned to watch from the sidelines. So how do you position yourself? What actions should you take when the delivery squeeze is already underway? Step 1. Acquire physical silver immediately. Not paper, not ETFs, not futures contracts. Physical metal in your possession or in allocated storage you control. The squeeze makes paper claims worthless if delivery cannot occur. Only physical holders are protected. Here is the tiered approach based on your resources. If you have $100, buy 3 1-ounce silver rounds. This gets you started. This gives you skin in the game. This is real money that cannot be defaulted on. Store it at home in a secure location. If you have $500, buy 15 ounces of silver. Mix of 1-ounce rounds and a 10-ounce bar. Diversify your sizes. Smaller denominations are easier to trade or sell in a crisis. Larger bars have lower premiums per ounce. If you have $2,500, buy 70 to 80 ounces of silver. Add 1/10 ounce of gold for diversification. You are building a meaningful position that can impact your financial future. Consider a home safe for secure storage. If you have $10,000, buy $250 to 300 ounces of silver and at least a 1/4 ounce of gold. At this level, consider splitting storage between home and a private vault. Do not keep everything in one location. If you have $50,000 or more, allocate 15% to 25% to physical precious metals. That is 400 to 600 ounces of silver and 2 to 5 ounces of gold. Use allocated storage in a private vault. Consider international storage for a portion of your holdings. Think like the institutions that are standing for delivery. Own metal that exists outside the banking system. Step 2. Act fast because premiums are rising. When delivery squeezes occur, dealer premiums spike. The spot price might be $31, but dealers charge $38 or $40 because they cannot source metal at the spot price. In the 2021 squeeze, premiums on American Silver Eagles hit $15 over spot. In extreme scenarios, dealers simply say, out of stock at any price. Right now, premiums are elevated but manageable. $4 to $6 over spot for common rounds and bars. If the squeeze intensifies, those premiums will double. Buy now while metal is available at reasonable prices. Step 3. Avoid paper silver entirely. SLV, the largest silver ETF, specifically states in its prospectus that it may not be able to acquire physical silver during periods of high demand. If the squeeze causes delivery failures, SLV holders get cash settlement, not metal. The price you receive in cash might be far below what physical silver is actually worth. Futures contracts are even worse. You are betting in the same casino that is being squeezed. Margin calls can wipe you out before the squeeze resolves in your favor. Leave the paper games to the professionals. Own physical. Step 4. Monitor the delivery reports daily. The COMEX publishes daily delivery notices. I track them and share updates on this channel. Watch for accelerating delivery demands. Watch for inventory drawdowns. Watch for unusual premiums being offered to settle in cash. The delivery squeeze plays out over the entire month. Day 1 was 4,200 contracts. Day 2, Day 3, Day 10 will tell us whether the pressure is building or fading. Stay informed. Adjust your position as conditions change. Step 5. Prepare for volatility, but do not panic. The banks will fight back. They always do. They will dump paper contracts to smash the price. They will shake out weak hands. They will create headlines about silver crashing. Ignore it. The paper price manipulation only works if you sell your physical metal. As long as you hold, you win. The squeeze resolves in favor of physical holders over time. The banks cannot create silver from nothing. They can only delay the reckoning. Hold your metal. Ignore the noise. Wait for physical reality to overwhelm paper fiction. 4,200 contracts. 21 million ounces demanded. Nearly half of COMEX registered inventory claimed on day 1. The banks are trapped. The squeeze is live. And this is just the beginning. But the delivery notices are only part of the story. There is one specific indicator that tracks whether the squeeze will succeed or fail. It has predicted every major silver price move for the past decade. And right now, it is flashing the most bullish signal I have ever seen. I break down exactly what that indicator is and what it means for silver prices in this video right here. Click it now. If you own silver or are thinking about buying, this is critical information. I will see you there.